Joe, earlier we spoke with David Kotok, who runs a very successful and very prominent investment firm, Cumberland Advisors. And you were surprised, and so was I, by the reversal of fortune in his voice since the last time we spoke to David. He was bullish about the first half of the year several weeks ago, and looked to the second half of the year for a decision point about whether the economy could continue to grow in the face of what you'd have to say is a headwind of joblessness and housing. But tonight, he was bearish. Is that a fair statement?
No, that's a very fair statement.
Yes.
And the truth is that the uncertainty has increased over the past week. Prior to the Middle East and North Africa becoming very, very difficult, really the decision was in our own hands. The Fed was going to exit the market come June, and then we were going to get a chance to take a look at the economy and see how we were doing. Now it looks like these uncertainties emanating from the Middle East, from North Africa, and the reverberation of those effects are going to hit us in a way that's negative, and that will tend to suppress growth. And I do have to say this, that many market participants that I'm talking to over the past number of days are echoing what David Kotok said. They're becoming a lot more pessimistic than they were just 14 days ago.
What does it mean that the VIX, the VIX, jumped more than it has in the last 9 months on today's trade?
Right. The VIX, for all you guys who don't know, that's the Chicago Board of Options Volatility Index. What that is that's a way for market participants to express an outlook. And that outlook is essentially fear. That's why we insiders, we call that the fear index. The higher the VIX goes, the more that's the market telling you that there's a problem, and that one should expect at least perhaps some give back in the equities markets.
We saw give back today, but let's move on to the domestic problems. We see in Madison, and today it spread to Indiana, we anticipate more troubles in state capitals because the states can't print money. Only the federal government can print money, and they have deficits. At this point, do these drag down the national economy, the states' quandaries as to how to balance a budget and facing union intransigence?
No, I think there's two things here. One is that those protests are not going to drag down the national economy. And in fact, what you're seeing is that the unions are actually giving a lot more than they would have given up otherwise. What we're seeing is political gamesmanship on the part of the Democratic Party and their union backers trying to preserve collective bargaining rights at the state and local level. Now, however that turns out, that's more of a political issue. But the fact remains that budgets are going to be cut. And over time, that will put these states and municipalities on a more sound footing. What we ought to be more worried about is are we going to have a government shutdown March 4th, and will anybody in Washington provide any semblance of leadership on the entitlement issues?
And that's what David Malpass spoke to, disappointed with the Republicans for not having an answer to the Democratic narrative, which is that shutdown is imminent because the Republicans in the House of Representatives are extremists. Mr. Malpass was also disappointed in the President of the United States in not addressing entitlement because that acts, in my words, as an act of cowardice for our children and our grandchildren.
Right. I mean, what's going on right now is both Obama and the GOP are playing a very nuanced game of trying to get the other to take the first leap off the cliff and suggest real cuts in entitlements. That's Medicare, Medicaid, and of course Social Security. And right now, to be honest with you, it looks like Mr. Obama has the advantage, because from what I understand, the House of Representatives, which is GOP controlled, in April will put forward cuts to entitlements.
Right. Which is, of course, very bad news if you're trying to win an election, because no matter how you argue, they stop listening after the word slash. So, all right, now, one more piece of disappointing news, but it's in the interest of transparency. We learned it tonight from Paul Dales of Capital Economics that at this point we're down 3.5% on the Case-Shiller on the year on housing, and he expects us to go 5% lower, and in our conversation with him, he wouldn't be surprised by a decline of maybe 5 or 7% more from here, because there's shadow inventory, there's too much supply, it's very difficult to get a mortgage, and right now the economy remains fragile, and you have no pricing power.
Yeah, it's certainly an interesting conundrum we have here where, I've come on the show for a number of months now telling you that I thought housing prices were going to fall 5 to 10% this year, and we're well on our way to doing that, and it's going to happen. I guess the sort of the silver lining is that housing plays a much smaller role in the economy than it did before the crisis. Roughly, it contributes around 2% to GDP. But of course, the problem is the more housing prices fall, the more those who own those homes, they feel less wealthy and they're less inclined to spend. So that does put a sort of a speed limit on how fast the economy can grow.
Joseph Brusuelas, who's a senior economist at Bloomberg Economics, part of Bloomberg LP, they put out a morning brief, but you just had it from Joseph Brusuelas. You can read it again tomorrow. I'm John Batchelor. Yes, we didn't give you any good news. You're right. You're looking over the summary. We don't have any good news tonight. Gaddafi's threatening to burn the wells. It means what you think it means. We're in trouble. I'm John Batchelor.